What's happening, everyone? This mini series is about you having a big old concentrated position and what to do about them. Okay. Today, we're going to talk about utilizing options and executing a strategy we call a caller. Okay. You're going to learn how and when to use it and who can and can't. Okay. I'm Joshua Staff, founder of Varick Private Wealth. I spent years working with families at JP Morgan, with families whose net worth and maybe complexity was increasing substantially. And usually when that happens, personal bandwidth goes the other way around and they need someone to manage their financial blind spots. I wanted to offer private wealth services in the independent space with some higher touch and depth, and founded Varick Private Wealth earlier this year. First off, don't trade options. Okay, there's no reason to. They're complicated. I think they should only be used for hedging purposes. I would say unless you can explain implied volatility to a 5-year-old, no reason to trade or even try to derive income. Okay, there are cleaner ways to do that. A caller isn't actually a way to diversify your position, okay, but it's a bridge and it buys you time until you figure out what you want to do next, all right? When you use this, say you hit it out of the park with SanDisk or after years of compensation in your employer stock, you're trying to spread out tax years or maybe trying to get to a longer term holding period. If you can't sell now, but you can't afford a 35% drop before you can, that's where this strategy plays. Okay, to understand how a caller works, you need to have a good grasp of how options in general work, and a caller both options make up a caller. Okay, we use both of them. With options, we have a call and we have a put. Okay, you can buy them for a premium, or you can sell them or write them or short them. That's all the same thing, and collect the premium. When you buy a call, you buy the right, not the obligation, to buy stock in the future for a specific price. Okay, when you buy a put, you buy the right, not the obligation, to sell a stock in the future for a specific price. Here's a quick example to get basics of this down. I don't think graphics or images work really well for this stuff. I think they can actually kind of muddy the waters and they can be a little confusing. So we're just going to talk about it the old-fashioned way. Okay, you have a stock. Stock A. Okay, it's trading at $10 a share. You like it. You're bullish. You can buy a call for a premium, say $1 a share. And what that does is it allows you to buy the stock, maybe say in 3 months, for $13 a share. So what happens in 3 months? You're correct. Okay, the stock's trading at $20 a share. You can purchase it for $13 a share. Okay, it's in a sense, it's a way to use leverage. That's how buying a call works. Selling a call is the opposite. You collect the premium and you give somebody else the right to buy the stock from you in the future. Now, a put. Say you own the stock and it's $10 a share, just like our own example. If it goes down, you want to protect yourself a little bit. So you buy a put for, say, $1 a share. Maybe that strike price was $8. So what we're saying is no matter where the stock goes in the future, even if it goes down to $2, you can still sell that stock for $8 a share. That's kind of the ins and outs, the 30,000 foot view. Now, for a caller, we both buy a put and sell a call. All right. We call it a protective put in this scenario since we have the stock already and we're putting a floor on how low we would accept the stock to fall before we take action. That's what this is. It's protection. Okay. It's like insurance, and insurance costs money. That's where the call comes in that we're selling. Okay. We call it a covered call because we already own the stock. We wouldn't have to go out into the marketplace and buy it should we be required to sell it to the person who's the holder of the call. If we didn't already own the stock, we would call that a naked call. That's no good at all. Okay. Risk galore. So the whole reason you're not just buying the put to protect the downside, it's to help finance it. Usually when a stock runs crazy, say it goes to $6 million. Generally, people are less concerned with it going up another $3 million, okay? But you're more concerned with it dropping $3 million. That's a significant hit. So you give up some potential upside by writing the call contract and collecting the premium to help pay for the insurance that you just bought, okay, the put. We call that a costless caller. Now, I know I just said graphics aren't that great, but we need to put some numbers or something. So let's take a look at this example right here. Now, the navy blue horizontal at the top, assume an investor owns 60,000 shares of a stock trading at $100 per share. Okay, that's a $6 million concentrated position. Now, they could purchase a put option with a $90 strike price for $3 a share. What that means is if the stock were to drop below $90, they would be allowed to sell the stock for $90 to the seller of the put, regardless of how low the market price of the stock actually fell. Even if it went to $5 a share, they could still sell it for $90 a share. Across 60,000 shares, that protection at $3 a share, that would cost $180,000. The right to sell the stock for $90 per share, it creates an approximate floor of $5.4 million. Now, to help pay for that protection, that 180 grand, the investor could also sell a call with $115 strike price and collect $3 a share or $180,000. So the premium received from selling the call offsets the premium paid for buying the put. That creates what is commonly called the costless or the zero cost collar before fees and taxes and differences in actual market pricing. For the life of the caller, you now have, or the investor now has, created a range around that position. Okay, the approximate floor is 5.4 million and the approximate ceiling is 6.9 million. If the stock falls to say $70 a share, the unprotected position, that would be worth 4.2 million. But because of the put, the investor can still sell at $90, protecting about 1.2 million of value. If the stock finishes at, say, $105, neither option materially changes the outcome. Okay, the shares are still worth approximately 6.3 million. But if the stock rises to $140 per share, that unhedged position, it would have been worth 8.4 million. But under the collar, the investor already agreed to sell at $115 and would receive approximately 6.9 million. That, my friends, is the trade-off. You establish a floor under the position, but you also place a ceiling over it. Okay. The collar does not diversify the investor. Okay. We have to say that again. You probably get that by now. What it does is it buys you time. Okay. You still own the stock. What it can do, though, is can reduce the damage from a major decline. It can buy time to basically execute a longer-term diversification strategy. Now, important IRS stuff. If you utilize the strategy and the range of outcomes, it's too narrow. In a sense, if the strike prices of the put and the call are too close to the market price of the stock, you've basically created a hedge that is almost too perfect in the eyes of the IRS, and they can force an immediate taxation of that gain. We got to watch out for that. They're basically saying you're no longer actually exposed to market risk at this point. So talk to me about this, bring in your accountants, and we'll make sure that you're covered on that. Last thing we'll cover, who can do this? Unfortunately, not everyone. Okay. An unfunny irony is a lot of people who could use this the most are the ones who can't use it at all. Okay. Most public companies, they don't allow for this. Their internal, their anti-hedging policies, or however they might refer to their specific guidelines. It's kind of a no-no. The SEC, it doesn't specifically ban it outright, but the main gatekeeper is the company for alignment and optics, as you can imagine. Okay. Not allowing their employees to take a negative position on their company stock. And that's what buying a put is. It's a bearish sentiment. So my guess is from whispers around the industry, there might be a couple companies that allow this, but truthfully, I don't know any myself. So this would need to wait until you're no longer there. So in summary, a collar is a tool to help buy you some time. You still need to eventually sell, donate, exchange, otherwise diversify. But it can be a very useful tool in the right situation. So if you want to talk through a specific situation, shoot me an email and we'll grab some time on the calendar. But that's it. Next week, we're going to talk about exchange funds. And that's pretty fun too. That's actually unwinding the position. So that's it. Go be good. Keep learning. And, call an old friend that you haven't talked to in a while. We'll see you next week.